In the seminal book, Who Moved My Cheese? Spencer Johnson talks about the two mice in a maze chasing the cheese. If the cheese were to be equated with a friendly budget, then our finance minister last week is certainly nudging us in a certain direction through the recently unveiled budget. In today's video, we're going to talk about three aspects. First is about the personal taxation slab. Second is about the lack of indexation benefit on long-term capital gains. Third, long-term capital gains on mutual funds. All these three aspects are going to be drilled down and discussed with numbers more in detail so that we understand what is the general direction which the government would like us to kind of move. So as discussed, we're going to discuss the tax slabs that were unveiled in the new budget. This pertains to the new regime of income tax that's applicable. In the tax slab, some of the slabs have increased. For instance, as compared to 3 to 6 lakhs earlier, now the slab has been extended and increased from 3 to 7 lakhs for a 5% taxation, and 7 to 10 lakhs as the next slab as compared to 6 to 9. 10 to 12 as compared to 9 to 12, and 12 to 15 is the same for both, and more than 15 is the same. There is also an increase in standard deduction from 50,000 to 75,000 in the new scheme, which helps salaried class to get a little bit spite from high inflation rate. We did a comparison of somebody who's below the age of 60 and how the tax slab works on a 10 lakh kind of take-home salary, and considering a standard deduction of 75,000, under the new regime, the tax works out to 44,200 including cess, while before the budget, the amount under the same new tax regime would be 54,000. So about 12,400 rupees of benefit coming in thanks to the kind of slab changes that have been provided. Interestingly, the same income, if it was subject to tax under the old regime, you would be paying about 75,000. So clearly, the old regime seems to be very, very expensive. The new regime after budget seems to be the one which most of us should be looking at. And we did a similar exercise for the people in the age profile of 60 to 80, and the results pan out very similarly. Our take is that invariably in the financial year 24-25, most of us would find it more beneficial to take up the new tax regime based on what the government has announced. So this is about the slab. So the nudge in this case is for us to adopt the new taxation regime. As far as real estate is concerned, the two important changes is that the indexation benefit has been eliminated for real estate. For properties bought before 2001, the rate as of 2001 will be considered. Also, the long-term capital gains taxation rate has been increased to 12.5% without indexation benefit as compared to the earlier 10%. So marginal rate change there. And we looked at properties that were bought before 2001, and we did a comparison based on some assumed numbers. And assuming that the purchase was done in 1995 for the property at 25 lakhs, and the property grew at a massive 16% rate year on year, and it is sold now at a fair market value of say 45 lakhs as of 2001, then you would find that the tax that one needs to pay before the budget, as per the provisions of the earlier year, is almost 10 lakhs lesser than the current proposed rates. So if you had a property that was bought before 2000 and has grown really, really well, you would end up paying a higher tax under the new regime, clearly. But this amount keeps coming down as rate of growth is lesser. So assuming that you had bought the property in 2001 and assuming that the property returned about 13%, we have assumed that in 2009 you bought a property for 50 lakhs, which you're selling it now at 3 crores. As per the earlier scheme of things, the net capital gain would be 37 lakhs, while the current post-budget rate of capital gains tax would be 32 lakhs. So in this event, you would end up with a much lesser capital gain as compared to the previous. So in terms of a shorter duration of holding, in terms of a lower growth of the asset, it seems that the newer tax regime is a better alternative than the older regime. This keeps varying. Again, we looked at one more example of a property bought after 2001 with an assumed rate of 9% growth. So 50 lakhs bought in 2009 being sold before budget. Long-term capital gains tax comes to about 11 lakhs. Long-term tax after budget comes to 16 lakhs. So in this case, the before budget rate is far more beneficial thanks to indexation and various other benefits. So clearly, some of the learnings is that if the appreciation is moderate and the period is shorter, tends to be that the new regime seems to be a little bit more beneficial. If the period is much longer, the appreciation is far higher, then you end up missing out the benefit on account of indexation. So that's about the real estate. And of course, last but not the least, about the mutual fund taxation. Earlier, there was a little bit of an anomaly. While in most cases, equity-oriented mutual funds had a 12 months duration between long and short-term duration. In case of other funds, like overseas fund of funds, gold fund of funds, equity fund of funds, and specified mutual funds with more than 65% in debt, all of them had a 36-month duration. That has been moved down to 24 months. So there's a significant change in that. So to be called a long-term asset, a gold fund or an overseas fund, you will just need to stay invested for 24 months as compared to 36 months earlier. And the short-term taxation rate for equity funds has moved from 15% to 20%. And in case of long-term, it has moved from 10% to 12.5%. So marginal rise in taxation rates, especially for equity-oriented funds. For all the other funds, the taxation rate is pretty much the same, except that in case of long term for equity fund of funds, overseas fund of funds, and gold fund of funds, if you stayed invested for more than 24 months, your taxation rate is 12.5%, like an equity fund. Whereas if it is below, it gets added to your maximum marginal taxation. So whatever is your actual taxation rate, that's what applies. So there has been some tweaks on the taxation in mutual funds. Clearly, all this alludes to the government making a little bit more money, taxing mutual funds on redemptions. But nothing to be done. There is a lot of prosperity in the equity markets and in the mutual fund industry. And it's only fair that the government wants a fair share of that as well. So that's about it. As we have seen from the detailed discussion, in conclusion, the three aspects relating to personal taxation, I think the nudge is towards moving to a more simpler regime and new regime of taxation. So government is keen on putting most of us into the new tax regime and not the old tax regime, which is why it's been made very, very interesting. The absence of indexation on real estate seems to be to convey a simpler administration on taxation. The mutual fund taxation, especially increase in capital gains rate, is essentially to convey that with growing prosperity, it's important that we as investors share something more with the government.